Hey, welcome to the Real Estate Investors community, where our goal is to connect you with other investors, no matter your experience. I'm glad that you're here. That they say that you're the average of the five people that you spend the most time around. Well, you're in the right place because now you've got people to connect with that are focused on the exact same thing that you are. So it'll help you grow as a real estate investor. For those of you that don't know me, I know some of you have followed me for a while. Some of you, this is brand new. This is the first time we're meeting. I'm Blake Choisnet. I retired with real estate after just a couple of years investing. I'll tell you more about my story as we have a conversation, but I've helped a few hundred people start and grow their own portfolios. And I want you to be able to move in that direction too, to be able to start and build your own cash flowing portfolio. I know there's a lot of people here, a lot of different types of people here. I know some are probably brand new to real estate investing, just looking to learn about it or figure out whether or not it can help them meet their goals. I know some of you probably have a lot of knowledge, have done a bunch of research, learned through like YouTube videos or podcasts, and now you're looking to take action so that you can really do something with your knowledge. And even some of you are more experienced, closed on a few properties, but you're looking for a way to refine your investing or learn how to scale your portfolio so that you can quit the job or be work optional or finally be able to get over that millionaire hump. And no matter where you're at, you're in the right place. I put together this 7-day quick start in order to help you get jump started so that you can start moving and making sure that you've got the tools that you need to be able to take action on investing in real estate. That way, you can have the cash flow and wealth that you need to be able to be work optional. So I'll tell you more about my story as we kind of go on. You'll learn a little bit more about me, but I want you to be able to spend your time the way that you want. I think everybody's made to work. Retirement, I know that means something different to everybody. For me, it just meant I didn't have to work if I didn't want to. And I know for a lot of people, some people say, I just want to quit. I hate my job. Some people say, my job's actually pretty good. I really enjoy it. I want you to be able to do what makes the most sense for you. And the best way to do that is to put yourself in a position where all of your expenses are covered by cash flow. And so the way that that's looked like for me is building up a cash flowing rental portfolio so I can do whatever I want with my time. So here's what you can expect. What we're going to do is, my goal is to help you get to a point where you can build your own cash flowing portfolio. So I'm going to give you over the next few sessions, I'm going to give you everything that I know. I'm not holding anything back. I'm not keeping something secret or saying like, oh no, these people only get this. These people only get this. I'm going to give you everything I can. Obviously, I can't just by the nature of how time works, I can't give you everything that I know, but I'm going to try and give you everything that I possibly can so that you can start and build a cash flowing rental portfolio. And it does not matter where you live and it doesn't matter how much money you have. All right, we're going to go through that in the next few sections in our conversation. But it does not matter where you live. And it doesn't matter how much you have. So if you live in a market where you say, golly, the cost of living is so high, it's too expensive here. I get you. That was my story too. Or you might say, I don't have much money. I'm not starting out with 100, 200, $500,000 to be able to start and scale a portfolio. That's fine. I didn't have much money to start either. So that's my goal, is to help you get to a point where you can start and build your own cash flowing real estate portfolio so that you can do whatever you want. So this is what it's going to look like. What it's going to look like is over the next few sessions, we're going to go through a few really important topics. Today, this session is going to be, our introduction, and then I'm going to talk a little bit about the money game, the game of money, and what the wealthy know that other people don't. Then we'll go into talking in the next session. We'll go into talking about your mission, your real estate mission statement, the difference between science and art, and the predictability of the game that I talked about today, the money game, how you can make it predictable instead of just variable, and how you can not know anything that's going to happen. You can know what's going to happen. Right? There's a difference between investing and gambling. All right. And we're going to talk about that. Day 3, we're going to talk about what new investors get wrong whenever they do actually jump in and start investing. And so the common mistakes, the top mistakes that they make that end up putting them underwater or going belly up or losing a ton of money, or worst case scenario, just completely giving up entirely and saying real estate investing doesn't work. It's the single greatest wealth creator in the history of the world. And so if you give up on that, you're giving up on a lot of opportunity. And so we don't want to do that. Day 4, we're going to talk about the biggest misconceptions and errors that people make, things that they might believe that are actually untrue, the things that they believe about real estate that are actually untrue, and what you can do to use that information the right information, not the wrong information, but use that information to be able to help you get a leg up, right? And be able to actually build your cash flowing portfolio. Day 5, we're going to talk about the importance of picking a market, how to pick a market, and how to build out automated deal flow so that you've got more than enough deals just flooding your inbox to be able to analyze and be able to close on those properties. Once you get all of those things automated, you pick a market that's in line with your goals and you end up having the automated deal flow coming in. Then you got to figure out, how do I actually close on this thing? How do I analyze it? How do I protect my downside? That's what we're going to go through in day 6. We're going to go through exactly how to find your first cash flowing deal. I'll even help analyze a little bit with you guys. And then on day 7, we're going to talk about creating predictable rehab when you do rehab on properties, predictable rehab, what your exit plan needs to be based on your goals, and then scaling to freedom so that you can actually get to a point where you can be work optional and say, you know what, I love to paint, but heck, maybe you suck at painting and you're not going to be able to monetize that at all and make anything. You can still paint. You can do what you like. Spend your time on the things that you care most about, whether that's your family, building out a nonprofit, starting the business, or heck, even painting. All right, so that's what we're going to talk about. All right, but we're going to talk about these things through the lens of experience. Where you guys want to go, building out a cash flowing rental portfolio and being able to be work optional and being financially free, multimillionaire, all that stuff. I've gone there. And so part of the challenge of being a new investor is you've got so many competing voices telling you, you got to do this, you got to do that, you got to do this. But a lot of them just haven't done anything. They haven't actually gone where you want to go. So I'm going to give you all of the expert tips, tricks, features to be able to keep yourself out of difficult positions and putting yourself into compromising positions. But then also I'm going to give you the information that you need to be able to predict when those things are going to happen and walk around them. All right. So I'm going to give you all the expert tips along the way. Now, I can't help but emphasize this enough. The people that have been most successful and have gotten rich and wealthy in real estate, they know this stuff. This is the stuff that they're confident in. They understand this stuff in a way that other people don't. And so don't skip this. Do not skip this information. It's vital. It's critical to you being able to actually do it as well. If you want to give yourself the best possible chance to be successful, you've got to watch this information all the way through. This is how the most successful people think. The wealthy people, the rich people, this is how they think. So there might be some things that you already know. That's great. I guarantee you there's going to be a lot of things that you don't know. So when you find things that you do know, focus on the things around that you didn't know to help grow your competency and grow your skills so you can continue to grow. But don't skip this information, because what you know that you don't know is fine. At least you know that you don't know it. But the things that you don't know, that is where you can put yourself in a ton of risk. Those are the things that you have to figure out. That is a lot scarier than the things that you don't know, right? You know that rehab might go over, but what you don't know that you don't know are a lot of the things that we're going to be talking about. So watch all this stuff all the way through so that you don't end up getting screwed in your investing. I'm literally giving you all the cheat codes, everything that I know. So soak them all in and don't throw them away. All right. So with that being said, what I want to jump into is what the wealthy know. We're going to talk about what the wealthy know, and then we're going to talk about later on what to do with that information, what they do that's different. But this is what they know that is different from everybody else. It gives them a distinct advantage over everybody else. All of the other peasants, all of the poor, they're taking advantage of unwritten rules that most people don't know, but they are rules. They're rules. It's the way that things operate. And so I'm going to go through the 5 things that the wealthy know about real estate investing that gives them a distinct advantage over everybody else. All right. The first part of that is cash flow. And a lot of you have probably heard about cash flow, but a lot of you might be thinking that cash flow is what it actually isn't. I think about a time I talked to a newer investor who had 3 doors and were excited about having lots of cash flow after these purchases that they closed on these properties. But after a few months of managing his portfolio, found out that his numbers weren't working. He came to me, he was concerned. He spent too much on maintenance and management and expenses that he wasn't quite sure of. That these are the things that I mentioned earlier, like that you don't know that you don't know. He was concerned, starting to get a little bit scared, a little bit anxious. And he said that he had $400 a month of cash flow. When I asked him, what's your cash flow on the property? So I came back to him. I said, "What do you mean by cash flow? When you say cash flow, what do you mean?" He said, "Well, my mortgage is about $900 a month, and I rent it for $1,400 a month or $1,300 a month. I can't remember which one it was." And I told him, I said, "That's your problem. That right there is your problem." His problem was that he didn't include everything that he needed to include in that property for it to actually be able to cash flow him. And as a result, he thought that he was going to be cash flowing $1,200 a month between all three properties, when actually he was coming out of pocket like $800 a month per property, and he couldn't sustain that. So that's why he was starting to get scared, nervous, a little bit anxious, because he was losing money every month when he thought that this was actually going to be his launching pad. He was actually going to be able to get out of his job. That is not cash flow. When you see somebody post online that they're making $900 a month on a long-term rental, $900 a month in cash flow on this one property, the likelihood of that being true is very, very low. It's probably just not true. And what they're doing is they're just taking rent minus their mortgage payment. And hopefully it's an escrowed mortgage payment. It's PITI, principal, interest, taxes, and insurance. But even if it covers that, after that, that is not cash flow. Cash flow is income minus expenses. It's income minus expenses. So that means all the income on the property minus all of the expenses on the property. And there are expenses on the property that you don't know that you don't know. So I'm going to give those to you. This includes things like maintenance, what we call real costs. So things that actually happen. So say property management, insurance, taxes, maintenance. So, some tenant flushes a diaper down the toilet, right? You've got to get that fixed. Those real costs. The other, what are called phantom costs. These are things that you know are going to happen, that you don't know when they're going to happen. They are statistical probability. They are going to happen. You just don't know when. Things like vacancy costs. Your tenant is going to move out. Your ideal tenant lives in your property for 30 years. And they pay rent increases every single year, and you're thrilled about it. The reality of that happening is just, it's not going to happen. People don't do that. They end up moving. They move to be closer to family. They buy a house, or they just want to live in a different part of town. Right. So that 30-year dream is not going to happen. So you're going to have vacancy. And it turns out the mortgage payment still wants to be paid, or the mortgage company still wants to be paid whenever that happens. They still need the mortgage payment to be paid. So you've got to be able to save up for that. Other phantom costs like a new roof, a foundation expense, things like that, capital expenses that you know are going to happen. You just don't know when. And when you get surprised by them, because you can't predict when they're going to happen, you can predict that they are going to happen. And so you can be setting aside the right amount of money to be able to cover your butt on those situations. So those are the things that you have to include in your expenses. You have income minus all of your expenses. All right. You got to save for future. You got to save for a rainy day, all of those things, so that you don't end up belly up. The reason people want cash flow, and the reason why sometimes they'll be wrong about it, or maybe they'll outright lie about the cash flow on their property. The reason that they want cash flow on their property, that they see it as so significant, is because they want control over their time. We are, what is it? Brene Brown says we're human beings, not human doings. We are made for specific things. A lot of it, I think human nature is you're made to work. People just don't want to do the job that they're doing. So when you retire, you're work optional. That doesn't mean that you're sitting on the beach forever. Most people, when they say that they want to be work optional or they want to retire, or they want to travel, 99% of those people, they don't want to travel 100% of the time. There's the small 1% that they just love sleeping in hostels, or they love hiking, or they just want to live outdoors. 99% of people, they just want a break. They want a time to breathe and just not have to check their inbox, or not have to get a text from their boss at Friday night as they're going to bed, or as they're at their kids play, or they're at the music concert, or they're at the football game for their son. They don't want to have to deal with those things. They want to be able to do the things that matter to them. And that's what cash flow affords them, is the ability to have control over their time. So that's the first thing I want to talk about. I want to talk about the power of cash flow. Okay. And again, some of you guys might know this, but I guarantee you there's a lot of stuff in here that you don't know. All right. So, if you know what you're doing, and you understand real estate, and you've got some competence there, you should be able to get a door every 90 days. And that might sound crazy. I'll talk about that here in a little bit, but you should be able to get a door every 90 days. Right now, I think you could get a door at $300 a month, bottom line cash flow. Very reasonable. I've got students finding doors at $500 a month, bottom line cash flow. Very doable, very reasonable. Now, if you're getting a door every 90 days, these are doors, not properties. So when I say door, I mean a single family home is one door, a quadplex would be four doors, a duplex two doors, and so forth. All right. So we're talking doors, not properties. And the reason that we do that is because the amount of units in a property has a distinct impact on the amount of cash flow that you can get on that property. It also has a distinct impact on the price that you're going to pay for that property. So it has a very significant forcing function. The best way for us to measure our cash flow is by doors, because those are the units that we're actually managing that are income producing assets. All right. So when you have these doors and you close on these doors, it's very reasonable to get $300 a month. All right. So if you just got four doors this year, you got a door every 90 days, that would be four doors in the next 12 months. At $300 a month, you just continue to stack those on. The beauty of this is when you close on one of these properties, because it's passive income, it's going to continue giving to you. You know, what is it? The set it and forget it. All right. So when you get one door, you're not just getting a door for this month, you're getting a door in perpetuity. It's going to keep giving to you over and over. Back when I was in my W 2, toward the end there, I was in a sales role. I was in a sales and business development role. And one of the things that frustrated me to no end was the work that I did today didn't matter tomorrow. The work that I did this quarter didn't matter tomorrow. I closed the biggest deal in our organization's history, and the next quarter it didn't matter. It was just gone. It didn't keep giving to me, and that frustrated me. So I wanted to find something that allowed me to when I put in the work, it continues to give to me. So when you get your first door, it's not just $300 a month; it's $300 next month too. And if you get to a point where you say, you know what, we're going to go on vacation, it doesn't matter because you don't have to put in that same amount of time in order to get that $300 door. So after this, you can go ahead, you get a second door. All right. And now it's not just that you got one more door, it's that you've doubled your cash flow. Now you're at $600 a month cash flow. Then in the next 90 days, you get your next door. You do that for door one, door two, door three. Then maybe you say, you know, I found a quadplex. You know, my quadplex, golly, this is great. 300 bucks a door. I mean, that just absolutely catapults you through the roof, right? And then you continue to do this over and over and over, and it allows you to keep stacking. So when you close on your 15th door, it's not that your 15th door is absolutely unbelievable. It's the fact that you still have doors 1 through 14 that continue to give to you. So now you don't just have $300 a month, you've got $4,500 a month because you've continued to stack these. It's kind of like the idea of habit stacking, only this will pay for all of your expenses. It'll allow you to retire and be financially free. So this is the beauty of cash flow. It allows you to continue to stack on the things that you invested in years ago, or maybe months ago, or heck, maybe even decades ago. Right now, I know some of you might say a door every 90 days, or how could I possibly ever get to 15 doors? Because I remember feeling that way. I remember feeling like even buying my first house was crazy. I remember signing on the dotted line and being like, I'm $250,000 in debt. And I grew up on, in Dave Ramsey world, where it was like, debt is all debt is bad, it's evil, you shouldn't touch any of it, right? So that was crazy to me. So some of you might be thinking, golly, how could I possibly do this? I'm going to tell you later in the presentation how to actually do this, like how to actually scale. There are because some of you might be saying, I don't have a ton of money to start out with, and that's fine. There are low and no money down options. We're going to talk about strategy. I'm going to go through over a dozen different strategies that you could use in real estate. But you need to pick the right strategy for you. We're going to talk about that too. And one of those, a handful of them actually, include low or no money down options. So you can scale, but that's a function of a specific strategy too. A good example of this, we could talk about house hacking or putting 20% down. Those are great models, but they're not scalable. If you're doing house hacking, you can only do a house hack loan really once every 12 months. So that best case scenario, you're closing one every year. Same with 20% down. Even if you put 20% down, even if you're in a good market, say an entry price in that market for a 3-bed, 2-bath, 1,400 square foot house is $100,000. There are tons of markets out there like that. You still need 20% down. So that's $20,000 plus closing costs, call it 25. In order to put, even just to do one deal a year, $25,000 a year, you got to make really good money and be very, very disciplined with that money. So it's difficult to be able to. So if you're not starting with all of that money, you say, how can I possibly buy a property that fast? The reality is, it took me 2 years to get to retirement, to replace my income, my 6-figure job, with real estate passive income. It is not as complex. It's much more simple than you might think. You just have to know how to do it and then actually execute on it, and then avoid some of the common pitfalls, which is why we're going through all of this stuff. Um, so that's the power. That's one of the powers of cash flow. Now, when you have all of these doors, they will continue to give to you in perpetuity. You're not going to be putting the same amount of work on door one as you are into door 15, because after you set these up, really 90 to 95% of the work is done before you close on the property. Even if it's a burr property and you're or a flip property and you're doing rehab on it, it's going to keep giving to you. That's the first piece of beauty about cash flow. The second piece of beauty, the second most beautiful thing about cash flow, I want to show you my favorite chart ever, is that mortgage payments only go up, or rent only goes up. That's one of the beautiful things about cash flow. This is my favorite chart. This is a chart of the historical median monthly rents in the United States. It goes up through 2021. There's an active one out there, but I keep this one on my desktop because it's just so beautiful. And we could talk about what you do see, but let's talk about what you don't see. What you don't see is this thing tanking or dipping, right? Even home prices go up and to the right over time. The S&P 500 goes up and to the right over time, but it's not. This is not volatile. Those are volatile. They go up and down. So if you need to liquidate and sell your stocks, or you need to sell whatever asset it is that you're holding, it could be at a bad time and you got to sell underwater. Rents don't do that. Rents only continue to climb, which is absolutely bonkers. So the power of this is, heck, next year or down the road, maybe you increase rent $100. If you got 15 doors, that's another $1,500 a month. Now you're not at $4,500 a month, you're at $6,000 a month, because your principal and interest payment does not change. You're on a fixed 30-year mortgage. It's not going to change over time. And that's why there's the old lady around the corner who, her mortgage payment's $48 and her house is an $800,000 thing of beauty. It's because she bought it a long time ago. All right. Rent does not go down. It always goes up. Now, there may be some people that say, no, it does go down, maybe month to month, but year over year, it does not go down. Right. The month, if you're trying to rent in November or December, yeah, it's going to be less than July because people don't want to move on Christmas Eve. But year over year, it does not go down. So I would ask you this. I mean, did rent prices even go down in 08, 09 when everything tanked? Right. So when the real estate market bottom fell out, home prices went down about 25%, but rent prices did not. In most markets, they actually went up slightly between 3 and 5%. Why is that? Well, the reason for that is because if you get foreclosed on, you now become a renter. So now there's increased demand on rents. Rents only go up. And that fixed mortgage payment is a thing of beauty where you can split it out over 30 years. And down the road, we're going to talk about the time value of money, but down the road, $1 is going to feel a lot bigger today than it will down the road, right? So that's one of the unbelievable things about cash flow. So how much? I would ask you this: what would you do if you had $4,500 a month, or $6,000 a month, or $10,000 a month coming in like clockwork? What would you be able to do with your time? Because if you had that amount of money coming in, even if it was just covering your core expenses, is it easier to make up the difference in 40 hours a week, or is it easier to make up the difference, in having to work your W-2? Right? Let's say your budget is $10,000 a month, and your core expenses on that are $6,000 a month. If you had $6,000 a month in cash flow, can you make the other four? It's easier to make $4,000 than it is $10,000 a month. Right? So maybe you spend 20 hours a week doing a job that isn't as stressful and still brings in the money, but you spend more time with your family, or you get to start the business or the startup or the nonprofit or whatever. You get to do whatever you want. You can paint if you want to, right? That's the beauty of cash flow. And not only is rents, they're not going to go down, they're only going up. I mean, this is, we look at this chart. This chart is my favorite chart, but you might say, well, where's that from? It's from a research group that focuses on apartments. But if you want to really go look it up, just go to the Fed. The Fed reports on this stuff. So if you just go search US, just go Google rent prices, United States history, right? This is what you'll see. The Federal Reserve prints this all out. It tells you, and look at this. It only goes up and to the right. You see it flat over here in 08, 09. But this is the Federal Reserve. This is This is the guy. All right. This is like the government saying these are the numbers. All right. So your number one source of truth, these are the numbers. And what do you not see? You don't see it going down. That's absolutely bonkers. All right. So if you have these doors and you've got enough money coming in, and maybe it's $4,500 a month, maybe it's 6,000, maybe it's 10,000 because rents continue to go up, you can then decide, what do I want to do with my time? And so I'd ask you that, what would you do with your time? And then second, how can you get to that number? What is your retirement number? Like what's your and when we talk about retirement, again, everybody's got different definitions of it. This doesn't mean that you're walking the golf course all the time, or maybe it does for you. It doesn't mean that you're sitting on a beach. It doesn't mean you're drinking Mai Tais. It just means that you're work optional and you don't have to work in order to eat or take care of your family or provide for those that you love. The way that you can calculate this is what I call your freedom number. Your freedom number is the number that covers all of your core expenses. All right, so it's not your monthly budget. Your freedom number will always be less than your monthly budget. This is not what number do you want to have out of your real estate portfolio. This is what do you need to cover your core expenses. All right, so this includes your rent or mortgage, insurance, car expenses, food. We're not talking steak dinners, but we're also not talking eating peanut butter on crackers, right? Generally, this is about 3 times what your rent or mortgages. All right. That's around the order of magnitude that your freedom number should be. Because then once you get to that number, you're work optional because you've got all of those expenses, the core expenses covered. Then you can either keep working at your job, you can go in and quit your job and go do something else part-time, or you can quit full-time and just reduce your lifestyle spend. At least you have options now. You don't have the golden handcuffs just tying you to your job where you can't escape no matter what you do. I mean, one of my students, this is for those of you that don't feel like, oh man, this might not even be possible for me. One of my students, a guy named Brandon, he built $2,700 a month in cash flow in 90 days. And that's while rates were high. When rates go down, that's going to double. He did that in 90 days. He didn't know anything about real estate ahead of time. If he can do it, you can do it. If I can do it, you can do it. It's a skill to be learned. He didn't know what he was doing beforehand, but once he had the tools and he knew what to do with them and the ways to protect his downside, he just absolutely cruised. All right. And not only that, but when we look at this, $4,500 a month, $6,000 a month, $10,000 a month, it's not just $6,000 a month. This is actually tax-free money. We're going to talk about this here in a little bit, but let's say you want the equivalent of a $120,000 a year job. That's $10,000 a month over 12 months, $120,000 a year. If you're making $10,000 a month, you're not seeing $10,000 in your pocket. You're seeing $6,000 because 40% is going to Uncle Sam. All right. But what if you could just keep that, right? That $6,000 a month is the equivalent of a $120,000 a year job because it's tax-free money. So we're going to talk about that here in a little bit. So that's the first component. That's the first thing that the wealthy know that regular Joes just don't. They understand the power of compounding cash flow stacking, being able to set something up to give to you indefinitely while you then go work on the next thing to stack up. So that's the first thing. The second is appreciation. When I moved to Austin, Texas, I left college. I was a good little boy. I studied real hard. I got a good degree because I was told, if you do all the right things, it will solve all your problems. And then you can be wealthy or you can have flexibility. You can blah, 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 blah. So I went to the university. I studied really hard. I gave up a lot of sleep. I gave up a lot of fun things that I really wanted to do in order to get the grades and the degrees that I did. I have an engineering background. I got degrees in mechanical and aerospace engineering. I'm a nerd. I originally went to university to study music. And I studied music. I played the saxophone for jazz music. I play a bunch of different instruments now. But part of the reason that I moved over to engineering was because I also wanted to have a big family. And I knew that even though that wasn't on the horizon right now, I knew I would have to be one of the elite musicians to be able to really reasonably be able to afford a big family. So I ended up moving over to working on engineering. So I get my degrees and I get a job offer in Austin, Texas. I say, okay, that's cool. It's got a cool music scene. I'm going to go there. Maybe I can play some music there. And so when went forward, cheated you guys, gave you a little sneak peek. So when I moved to Austin, Texas, I get down there And I'm working for this tech company down there, and homes were just so expensive. They're so expensive. So I'm renting. And every 6 months, a buddy either gets a new job or gets married and moves out. So I'm renting with a bunch of guys. And everybody that I talked to said, "Man, I wish I had bought 5 years ago. Golly, I should have bought 5 years ago," because Austin was just exploding at the time. And so I thought, well, what's keeping me from buying a property? Well, okay, so I went ahead and started looking at properties because I just wanted to be able to have my own place. My first property was $250,000. I bought it for $250,000. And when I bought it, I thought, well, I'll just rent out the other rooms to my buddies. That way, at least I've got control of the property, and I'm a little bit of a homebody, so I can just kind of lounge at my own place. I can put football on. I can do whatever I want instead of having to wonder, are we going to have to move in 3 months or in 6 months or whatever, find new roommates. So I bought the property. I rented it out to my buddies. My mortgage payment was $1,547 a month, and so I rented out the other three rooms. It was a 4-bed, 2-bath. The other three rooms at $1,600 or at $600 a month. So that came out to $1,800 a month. So I was covered. My mortgage was covered. I wasn't even paying rent. Right. So I was living for free. Then years later, I meet my wife, Brittany, who you saw in the picture earlier. We've got a son, 2.5-year-old now. And I met Brittany, and we decided to get married and settle down in East Texas. So I moved it's about 2 hours due east of Dallas to a place called Tyler, Texas, a community of about 120,000 people. So we moved there. I kept renting out the property, but the market started going crazy in Austin after that. And so I decided to sell. And this is only 4 years after I bought it. I decided to sell. So I bought it at 250. I listed it at 399. All right. Hoping, maybe we get 399, maybe a little bit over. And we closed at 497. So in 4 years, I bought something at 250, and then it sold at almost 500. I walked away at closing with a $250,000 check. That was an insane amount of money. That was, 4 times my net worth at the time. That was absolutely bonkers. That is the power of appreciation. That is why appreciation is so absolutely powerful and life-changing. Appreciation at its core is the increase in value of an asset over time relative to its original purchase price. Right? So this is the same thing as if you buy a stock. Right? Let's say you buy a stock at $100, it goes up to 110, you made $10, right? It appreciated in value. Now, you guys are all very well familiar with this, especially if you live in a big market. This is all over the place. You just go look at Zillow. I found this property in Austin, Texas, 610 West Elizabeth Street, 4.3, 2,400 square feet. Doesn't look anything. It's not super fancy. It's fine, right? It was in 2009. It sold for $360,000. I want you to take a guess in 2024 what it sold for. October of 2024. What do you think? Think it's higher, lower? All right. This is what it's worth now. Almost $2 million. $2 million. All right. So it's only in 25 years, it went from 360 to almost $2 million. So it went up over 4x in 25 years. That's crazy. I mean, imagine the old lady that bought that at $360,000 in 2009 and just sold it at $2 million. Now she can do whatever she wants. She can go spoil her grandkids. She can go travel, whatever, but she's got it. Everything's covered. Right. And these are all over the place. This is one in California, right? This one, the one that we just looked at was over 25 years, but between November of 2020 in March of 2021, what is that, 4 months? This one went from 700 to 929. Right now, that time was was the COVID time. The real estate market was crazy, but this is the power of appreciation. It's ridiculous. Appreciation is what creates wealth. It's a massive wealth creator, and it's caused by 3 things. So I want you to understand, if you're going to play with appreciation and try and control it, you have to understand what it's made up of. So I want to talk about what 3 things make up appreciation. There's 3 things. First is supply and demand. Right? If we want our investing to be predictable and reliable, we've got to know what makes up the core things, the core features that we're looking into. So the first thing that makes up appreciation is supply and demand. Land is a fixed resource. There is no more supply. It's fixed. Right. So when supply goes up and demand stays the same, price goes down. Right. Because there's more people or the same amount of people, but a lot more out there. I mean, you see this in the World Series tickets or NFL tickets. If your team sucks and the same amount of people are looking for tickets, the demand has gone down, so prices go down. But with the Super Bowl, tons of people want to go, but there's only a certain amount of supply, and so price goes through the roof. And in our case, with real estate, land is a fixed resource. Mark Twain said, "Buy land." They're not making it anymore. Right? There's no more land is going to be made. So that's one of the core components of buying real estate is the supply is limited and the demand will only increase. And this is only going to continue to go up because of supply and demand. They're not making any more land, but we are making more people. Population is one of the primary factors here. The number of people continues to grow. So the number of people continue to grow, but land amount stays the same. So that means land gets more expensive. This is essentially a bet on the American economy. That's functionally, that's what it is. You think of, like I mentioned, the old lady next door that bought her house for $7,000 and now it's worth $600,000. The reason for that is because the demand continued to go up and the American economy is so reliable. It only continues to go up and to the right over time. So you're not going to be selling as soon as possible. You're going to be holding on to this thing. Right? You're going to hold it long term so that you can continue to realize this appreciation. Right? You're literally not doing anything to make this appreciation happen. You just buy it, set it up the right way, make sure that the rent has a positive cash flow profile so that over time they pay down your note. And in 30 years, you've got a free home. You're not doing anything. You're just going to bed, you're waking it up, and every now and again you check your portfolio or check a P&L statement. That's all. This is the reason, this supply and demand component is the reason why homeowners have such a higher wealth than renters. Renters generally, their wealth is somewhere around, on average, around $6,300. For those that own a home, and this is just a primary home, this isn't even investing, just owning a primary home, the wealth, the net worth of individuals that own a home is 40 times greater. 40 times greater. It's almost $300,000. That's insane. And that's just a primary residence. Imagine what type of wealth would be created through appreciation just by supply and demand if you just bought a door every year or one every 90 days and then continued to scale. That's absolutely bonkers. So that's the first component is supply and demand. They're not making any more and people keep increasing. The second is the increase in the value of the market. This is more of an increase in intrinsic value of the market. So, for example, yes, people are still being born, but as people are being born, where do they want to live? So the increase in the intrinsic value of the market means the market has gotten sexier. It's gotten more popular. It's gotten better. So why would that happen? Well, cool things move there. Maybe you got a Topgolf, if you got great restaurants, or you've got a great artistic life. You've got a lot of things in that market that make people want to move there. All right. California is always going to have their beach. They're going to have their mountains, but then they've got movies, right? They've got Hollywood. They've got great food. That's why people want to move there. That's why you see markets like Nashville, Portland, New York, Austin, Dallas. They're all growing because the intrinsic value of the market is increasing. They're adding more jobs. It's easier to get employed there. They've got monorail. They've got public transportation to make it easier for you to do the things that you want and continue to live the life that you want. So it's the increasing of the value of the market, the intrinsic value of the market. This increases demand disproportionately. And that's really why when we looked at the Austin numbers, why in 25 years it went up 400x. That's crazy, right? The intrinsic value of the market is driving that appreciation. That's the second component. The third is the change in the value of the dollar. So appreciation is driven a lot by supply and demand. Second, by the increase in the value of the market, the intrinsic value of the market. And third, by the change in the dollar, right? And when we look at this property in 2009, you might say, yeah, it was $360,000, but that's essentially, maybe that's the same as the 1.895 as it is now, as far as purchasing power is concerned. And that's not true, but I understand that argument because of the change in the value of the dollar. For people that don't understand what I'm talking about, what I mean about the change in the value of the dollar is a dollar today is worth different than a dollar in 10 years. A dollar in 10 years is worth substantially less than a dollar today. This is called the time value of money. And there's a ton of different formulas and science out there and statistics out there to be able to predict the future value of money. Now, that's what I'm talking about. So this the time value of money, money previously used to buy a lot more. This is an example of it. In 1913 is when this chart starts. That's when the Fed was started. The Fed was started over 100 years ago. And if you took $25 purchase power for $25, this is the trend, right? So in 1920, it goes. I mean, it cuts in half, almost in half. And then we've got the stock market crash, the Great Depression. So it increases in value a little bit. President Roosevelt um, criminalized the possession of gold, and then we ended up going on to the gold standard in the 40s. Then we abandoned the gold standards in the 70s, and now we have a fiat currency, which means we can print all the money that we want. All right, and we start quantitative easing. And what we saw in 2020, 2021 was of all the money that was out there, we printed 80% of it. Right, all the money that was out there at the time, we printed 80% of it. And so what we did was we grew the money supply so much in 2020 that it was equal to 20% of all the dollars ever even created, ever. So all of this green area, right? If we look down here at the bottom, this is what the purchasing power of a dollar would get you in 2020 dollar. If you had it back in 1913, you could buy 30 Hershey's chocolate bars. Heck, 10 rolls of toilet paper in 1929. 10 rolls of toilet paper now, that's it's 15 bucks, 15, 20 bucks. You can get that for $1. But now a dollar only gets you a Coke at McDonald's. All right. That's what I mean by the time value of money. When we printed 80% of money, people say, that's not the reason for inflation. 100% it is the reason for inflation. And here's why. Imagine that we put 10 kids in a circle and we gave each of them 10 crisp $1 bills and a few candy bars. And we said, all right, the game here is to be able to get as many candy bars with as much money in your hands as possible. All right. So we'll have a scoring system based on the balance of both. And we let them start trading. And they say, well, I'll sell you my candy bar and for $1. Another one says, I'll pay $2. Another one says, no, 50 cents. Right. The dollar value or the value that someone's going to pay, the price they're going to pay for that Snickers bar or that candy bar, maybe it comes out to be $1 each. What happens if we pause that game? What happens if we pause that game and we give each of those people $10,000, each of those kids, and then we just say, all right, go again, keep playing? What's going to happen to the price of the candy? It's going to go up, right? Because you get the first kid is going to say, I'm not selling this for $1. I'm going to sell it for $5. Someone says, oh, okay, fine. I got a ton of extra money in my pocket. And then the next kid's going to say, I'm not going to do $5. I'm going to do $20. And then it's $50 and then $100. And maybe it starts evening out at $500 a candy bar. That's the equivalent of all of the money that we just printed. That's why prices are going up. That's why gas is going up. That's why costs of milk and bread are going up, because there's just way more money out there. And because there's more money out there, all of the supply chain is disrupted. So if one piece of the supply chain changes, they say, well, my expenses just went up, so I've got to charge more money. I got to charge more money for my good or service. And those prices just continue to go up and through the roof. That is why inflation is happening. But what it tells us is inflation has an impact on appreciation of a property. Home values tend to double every 10 years. They tend to double every 10 years. So if you buy a $100,000 property today, in 10 years, it'll be worth 200. 10 years from then, it will be worth 400. I think that number is probably going to decrease to between 6 and 8 years because we printed so much money. And I think over the next 10 to 20 years, you'll see that number, instead of being 10 a year, you're going to see it be closer to 6 to 8 years. That's what I think. Nobody's got a crystal ball, but with all the money that we printed, that's absolutely insane. But that's the third component of inflation, or of appreciation, is the change in the dollar value, the change in the value of the dollar. So appreciation is made up of supply and demand, the increase in the intrinsic value of a market, and the change in the value of the dollar. But the reason why you like appreciation is because it's low risk. Home prices only go up and to the right. But in order to hold a property long term, you have to have cash flow. This is what gets you through dry spells so that you can sell for profit whenever it makes sense. So when I bought my house at $250,000, I had to be able to afford it and pay the payments until it got to selling it at $497,000. Otherwise, I wouldn't have walked away with that $250,000. If I'm underwater on my payments, I'm going to get foreclosed on, or I'm going to have to sell when I'm at a negative and go belly up, right? Now, whenever you sell a property like that, we're going to talk about this here in a little bit. One of my favorite things is taxes. You might think, well, you got to pay taxes on that $250,000, so really you're only walking away with $150,000, and you would be wrong. You don't have to pay taxes on that property because it's a primary residence. So we'll talk about that here in a little bit. But that's fundamentally, those three things are what appreciation is. But we made an assumption. There's actually two types of appreciation. What we just talked about is the first type. That's natural appreciation. That's made up of supply and demand, the intrinsic value of a market, and the change in the value of the dollar. So we just talked about that. The second is forced appreciation. Forced appreciation, you can actually control this. You can't really control supply and demand, can't really control the intrinsic value of the market unless you're in a governmental body that's helping negotiate, the economic impact development committee for that community. You can't control it. You can control forced appreciation. There are two types of forced appreciation. One is physical and the other is operational. Physical means, you fix it up, you make it nicer. Maybe it's not in great shape. You put some lipstick on it, you paint it, and you make it more desirable, right? The Chip and Joanna Gaines, the Fixer Upper, the HGTV Property Brothers, those types of things. You're actually physically repairing the property. And you can do that on a single family home. You can do that on a 500-unit apartment complex. That's the physical forced appreciation. The other that a lot of people don't know about is operational forced appreciation. What you can do is decrease expenses. You can increase the income of a property because larger asset classes like multifamily properties, the value of them is actually driven by the income on the property. And so if you find a property that's at 50% occupancy because it's managed by a guy that inherited it from his dad and he doesn't have any software to collect rent. He doesn't have any tenant screening processes that are documented, and he collects rent by hand. He goes to the property on the first of every single month to collect rent. I'm guessing that collection process probably isn't going to be very helpful, and the documentation isn't going to be very helpful. Their numbers aren't going to be very valuable on the property. But if it's only filled at 50% and you buy that property and you can just fill it all the way up by putting systems in place, you can double the value of that property. So if you buy it at $1 million and you just put butts in seats, it'll be worth $2 million. That is another function of forced appreciation. You've got the physical restoration of a property and you have the operational improvements on a property. Generally, for newer investors, when they're starting, the forced appreciation of property is almost exclusively physical, because you should be starting with something that minimizes your risk profile. We'll talk about this a little bit later, but your risk profile, the reason why you start with a property that's $100,000 instead of a $5 million apartment complex is because of your risk exposure. Let's say you screw it up 10%, you screw up a $100,000 property 10%, that's only 10 grand. Nobody wants to lose 10 grand, but that's a worst case scenario. That's not very bad. You do that on a $5 million property and you lose $500,000, you're bankrupt. All right, that's the reason why you don't start there. And so the single family, the small multifamily, duplex up to quadplex, it's usually physical improvements. Larger multifamily is operational improvements. And people make a big mistake. They make a big mistake by focusing their only strategy on appreciation, and it's their only priority. And it's really expensive up front, and you lose money every single month. But if you do it right, and it's a part of your process, and you set up the deal in the right way, appreciation will make you a multimillionaire. That is the power of appreciation. Historically, home prices, like I said, they double every 10 years. You could buy a $100,000 property for your child. By the time that they're 10, you've got another $100,000 in equity on that property. So you bought it at 100, now it's worth 200. You have $100,000 of equity in that property that if you sold it, you could monetize right now. And that doesn't even take into account the cash flow and the debt pay down and the other advantages on that property. And if you had 15 doors, like we talked about earlier, I mean, that's $1.5 million, $1.5 million just by buying a $100,000 property and doing that every 90 days. And then in 10 years, $1.5 million. Right? That is something you can retire on. Even if you wanted to liquidate the entire portfolio and just go put it in some hyper conservative 401k plan or have some money manager manage your money, that would be doable. But that's what's absolutely unbelievable and powerful about appreciation. Appreciation is the most powerful wealth driver in real estate. Cash flow can retire you. Others help you make money different ways, but appreciation makes you a multimillionaire. So that's the second thing that the wealthy know. All right. The third is they understand the value in real estate of debt pay down. There's a few different times in my life where in my investing journey where I had kind of aha moments. I think of really two of them. My first aha moment was I had finished up university. I moved to Austin. Everybody was saying I wish I'd bought 5 years ago, and I was renting my house out, which is known as house hacking. So house hacking is when you put a low down payment down, you get some benefits. Instead of putting 20% down, you put 3.5% down, maybe 5% down. There's some programs for 0% down. But the only reason you can do that is because you're going to live in the house. So I lived in the house, rented out the other rooms, and I had this aha moment where I realized I'm owning property and I'm not even paying for it. I'm making money monthly, about $300 a month monthly. So on top of what I would be paying for rent, which was probably about $800 to $1,000 a month, I was now making $300. Right. So net, I was up $1,100 to $1,300 a month. All right. So that was my first aha moment, which was somebody actually is paying for my property. I'm not paying anything for this, but I'm making money monthly. And I was seeing the equity. Of course, I'm tracking it on the Z estimate on Zillow, but it's still absolutely unbelievably powerful. All right. That was my first aha moment. My second aha moment was I thought, man, I was talking to a buddy of mine. I said, well, if I just get a one rental a year, and I did this house hacking thing, I did this once a year, I could buy a property every year. I'd have to save up and I could put 3.5% down. So it'd allow me to buy more expensive properties, keep renting them out. Then in 15 years, if I put them all on 15-year notes, in 15 years, they'd all be paid off. Dang, they'd be free and clear. And then not only that, in 15 years, every year after that, I would have another free and clear property. So the first property, 15 years later, I got a free and clear property. Second property, 15 years later, a free and clear property. So for me, in 15 years, that meant that was the end of my W-2 life. That was the end of me having to work. And so I had a time frame. Once I had that time frame, there's a lot of research that says once you know that a problem can be solved, you're 80% more likely to solve it. So just knowing the fact that it can be solved means you're more likely to actually solve it yourself. And so when I realized that, I thought, golly, that's crazy. Then I could take the money out. I could sell the property. I could just take the cash flow, take more cash flow. That's unbelievable. But I knew that my W-2 had an end date. And that was my second aha moment. And the reason for all of that is because someone else was paying down my debt. Someone else was paying the $250,000 loan that I took out on my first property. My tenants were paying down. And all of the properties that I bought in that 15-year plan was going to be somebody else paying down that debt. Even if I wasn't cash flowing, that didn't matter. Now, the debt pay down is powerful because it's almost a hidden benefit of real estate. Because when you have a monthly payment on your house, really, you don't care about the split between principal and interest. If you look granularly, yeah, but most people aren't thinking about it. They're just saying my cash flow is, I rented it out for $1,500 a month. My monthly mortgage payment's $500 a month. All right. So they think then I've got about another $500 or $600 a month in expenses. So I cash flow $400 a month on that. They're not thinking about the value of the debt pay down. Every mortgage payment is split into principal and interest. The interest is front loaded. So the reason they front load it is because their goal with this is to keep your payment flat. It's to keep your monthly payment the exact same. And so taking this example, let's say we got a $250,000 loan at 4% interest, and we're not escrowing anything. This is just principal and interest. All right. This is what the loan balance looks like. The loan balance starts going down a little bit at the front end and then really starts to accelerate on the back end. So you have the interest paid is the red line, and then your total cost for this property in yellow. right? And then the total principal that you actually paid, right? And you see that the principal angle of the principal is exactly the inverse of the balance that you have on the property, right? Now, these numbers aren't made up. You can do this on any amortization calculator. If you go plug in a 30-year mortgage on $250,000 loan balance at 4%, you're going to come out with $11.93 a month, no matter what you use. This is my amortization schedule calculator, $11.93 a month. We've got in principal 360 and in interest 833 on the first payment. All right, and then we pay down a little bit of the balance, a few $100. So now our new principal, to calculate it on 4%, we're paying down a little bit more, right? But the important part of this is when this number right here, over the course of the first year, might not sound crazy or life changing or anything, but in this first 12 months, you paid down $4,400. You paid down $4,400 of principal. So if you were to sell that the next day, you would cash out $4,400. So this is essentially a savings account that the tenant is paying into for you. So when they pay down your principal, you are making money. You just can't go spend it on your kids or your family or whatnot. But you're making money just on the principal pay down. And so in 12 months at the end of this, you're going to make $4,400 in savings just on principal. And on a 20% down, if you put 20% down on a property like this, that's what, $50,000, 4,400 over $50,000. That's 8%. That's an 8% return on the debt pay down alone. 8%. That's 99% of active stock traders can't even get 8% in the stock market in active trading, right? That's essentially the return of an index fund without including cash flow, appreciation, and everything else. That's crazy. Last I checked, we looked at our principal pay down. We made about $250,000 in the last 6 months just on principal pay down alone. And so that as well will make you a multimillionaire. Just the debt pay down, right? So the appreciation combined with the debt pay down is a recipe for being a millionaire. Now, when you buy this property and you have that monthly payment, you're going to be paying it down every month, right? And as you're paying it down, of course, you've got a widening gap between what you owe on the property and what you paid for the property. So this gap between the blue and the black, that is the money that you have earned. So while in the first month or the first 12 months, maybe you only make $4,400, but when you get down there to 20 years in or so, you've made hundreds of thousands of dollars. So that by the end of this, in 30 years, you've got a $250,000 property owned free and clear. That's $250,000. And if the tenant is paying this, they paid all of that for you. You don't, and so you don't really even care about the interest cost. And we'll talk about that even more later. It's actually kind of a benefit for you. It's a tax hedge for you. You've got $250,000 in 30 years. But more significant than that is you have more than $250,000, because when you bought this 30 years ago, home prices tend to double every 10 years, right? So if you bought it at 250, in 10 years after that, it's going to be worth 500, right? It's $500,000. 10 years after that, it's going to double again. What's it going to double to? $2 million, right? So that you're going to have a $2 million asset right there, right? It's an absolutely bonkers amount of money. So you're going to start off with $250,000, then it goes to 500, then it doubles to $1 million after 20 years, and then it's worth $2 million after 30 years. That's the exact story with the property that we just looked at. Right? They bought it at 360, and in 24 years, it was worth $2 million. This is the exact same story. This is just a regular run-of-the-mill property that you bought for $250,000. So that in 30 years, you've got $2 million. That's the power of debt pay down. Debt pay down is often forgotten because it's not quite as sexy as the others. When people talk about tax strategies, or they talk about appreciation or cash flow, like those are really the sexy ones. But debt pay down, it's the unsung hero. It's the sixth man. It deserves the sixth man award. It's just not quite as sexy as the others, but it is unbelievably powerful. It'll be a hyper contributor to you becoming a millionaire. So that's the third component. All right. Speaking of some of the other components that are sexy, the fourth component, we talked about cash flow, we talked about appreciation, just talked about debt pay down. Of the 5 ways that real estate transforms wealth is tax savings. Now, everybody talks about tax savings, but a lot of people get tax savings wrong. They think, well, if you make money, then you just spend it so you don't have to pay taxes on it. If you make $100,000, but then you just go spend $100,000 so that you don't have to pay taxes on it, you're not going to be able to spend it on things that you want, right? So you don't just want to go arbitrarily spend money. You want to have a distinct advantage. I think about a student that joined the program, the rental roadmap program that I run. And his name's Matt Rogers. He started out. He was working in a big city at a tech company. He was working in kind of a business development type of role, sales ish. And really, he just wanted to start being able to provide for his family. But being in a commissioned role, he was frustrated that as he closed big deals, it really just made money for his boss or his boss's boss. And he was tired of when he had big successes, it just going to somebody else. And so he started investing in real estate. And because he wants to build wealth for his family, and not have to just make wealth for somebody else. He went 0 to 12 doors in 8 months. Didn't know anything about real estate ahead of time. Went 0 to 12 doors in 8 months. Built $500,000 in equity in net worth on those properties in 8 months. Now he's got 15 plus doors. And he's about to become a self-made millionaire. He just got under contract on a property on a turnkey deal with no money out of pocket. But in addition to that, in his first year, he saved $55,000 in taxes just because of his properties. That is the benefit of real estate investing. So he $55,000 in his pocket. This isn't like just tax credits, or it's not tax advantage. This is actually $55,000 he can go spend tomorrow because he invested in real estate. And that's why the tax savings is one of my favorites. I never thought I'd have as many books on tax strategies as I actually do, but it's the ultimate wealth hack. I'm going to show you exactly how the tax savings on real estate can transform your wealth. But in order to show you how it works, we've got to be very clear on what's happening when you make money. It is not, Robert Kiyosaki is really famous for saying it's not how much money you make, it's how much money you keep. It's not how much money you make, it's how much money you keep. There is a big difference between what you make and what you get paid. Right? We talked about if you make $100,000, you're really only getting paid $60,000. Right? You need to keep every dollar that you can. The big difference between what you make and what you get paid. Every dollar that you make, 40 cents of that is going to Uncle Sam. So if you make that 100K, you're not actually making six figures. You're really only making 60. Right? That's $5,000 a month to be able to spend because Uncle Sam is chewing through the rest of it. But what if you could save that 40%? What if you could actually use that 40%? Tell me about anything you could do at your W-2 or your job that would give you a 40% increase. All right. No matter how successful you are on your next project or how early you deliver on your next deadline, they're not going to give you a 40% increase. This can give you a 40% increase. The key to tax savings is that the IRS sees money different than you do. The IRS sees money different than you do. A person, an individual, is taxed on what they earn. A business is not taxed that way. A business is taxed on what they profit. So you're taxed on what you earn. So no matter how much you're spending of your $100,000 a year salary, you're taxed on all of it. A business is not taxed that way. Business is taxed on what it profits. So if it makes $100,000, but it costs $99,000 to make that $100,000 because of marketing expenses, advertising, et cetera, product development, they're only taxed on $1,000, which means 40% of $1,000, they only pay $400 in taxes, but they made $100,000. It might seem trivial, but it's unbelievably significant, right? The IRS looks at property different than you and I do. They care about the operational expenses. So when you're running a business and you have expenses on a property, the IRS counts those differently. So what I want to do is I want to walk through how you actually save money on taxes and the actual numbers behind it. We're going to use an example of just a run-of-the-mill property. All right, so let's do that. Here's our example. We have you on the left. We got the IRS on the right. I mentioned you see things different than they do. All right, you see things different than the IRS does. So when you're looking at a property and you're analyzing it, you're saying, okay, this property rents for $1,200 a month. I'm buying it for, call it $100,000 property. Just a standard $100,000 property, 1.2 rent to price ratio. That's not even anything sexy. All right. So on that property, your mortgage payment is going to be $65 of principal and $467 of interest. All right. At prevailing rates. I think I used 7% on this. That type of property, you're probably paying about $90 a month in property taxes. Your insurance payment is probably around the same order of magnitude, $80 a month. You got property management that's going to be $10, 10% of the rent. You got setting aside money for maintenance, capex, vacancy, and then your total at the bottom end is a little over $1,000 a month. All right, so you've got almost $200 a month in cash flow. And so on a yearly basis, that's $2,400 a year. That's great. That's helpful. That's not going to be life-changing money, but it's helpful because you have some of the other return profiles that we just talked about. But the IRS doesn't see it that way. So we'll just go ahead and copy and paste everything because the numbers are the same, but the way they interpret them is different. The first thing is you've got rent, yeah, $1,200 coming in. They don't consider principal to be a business expense because it's saving, what we just talked about previously. It's equity into the property. So you don't get to count that toward the operational expenses on your property. So our total traditional operating expenses is $937 a month. All right. So the IRS sees us making, what is that, $270 a month or so. But there's one other expense the IRS has to take into account. The property that you're buying, it's made out of physical material that's going to degrade over time. It's going to wear away. Even bricks are going to wear away. The wood is going to rot. Electrical is going to need to be replaced. And so you have to repair that. All right. We talked about appreciation previously, but we also need to talk about depreciation. Depreciation isn't just the decline in the value of the property. Depreciation from a tax standpoint is putting a number to how much of that property is wearing away this year. The IRS has to put a number to that. They have to put a number to how much of that is breaking down over time. And the way that they do that is they take the value of the property and they divide it by 27 and a half years. So it's depreciated over a 27 and a half year time frame. So if you got a $275,000 property, that's $10,000 a year that you depreciate and you write off as an expense. So they say, you know what? The natural wear and tear on your property is $10,000, or it's the value divided by 27 and a half. So on a property like this, our depreciation on this property is a little over $3,600 a year, which means that comes out to $300 a month, which means our cash flow, the way the IRS sees it, looks like we're losing almost $500 a year. And that's significant. Now, you might not think that that's a ton, but the reason this matters is every dollar that you get over here on the left, that $200 a month, that's all tax free. All right, so the $200 a month, you're not going to be taxed on that. That's the first component. The other component is you can actually offset your active income. So for me, on average, the properties that I buy, it looks to the IRS like I'm losing $6,000 on average. So if I just have 10 properties, that looks like I'm losing $60,000, right? You can actually apply these losses to your active income. All right. Now, this is the obligatory. I'm not an accountant. I'm not a CPA. So, of course, work with your CPA for your specific situation. This is just educational in nature. But let's say we use that $6,000 number. All right. Negative $6,000. If we took on one side, let's say you're making $100,000. The other side, let's just say you got 16 doors. 16 doors times $6,000 in the hole on every one is negative $100,000. What they do is they take that $100,000 profit, and then on the other side, you've got a $100,000 loss to the IRS. You add those together, and that's your total income. So you made $0 the way the IRS sees it. And they say, we are going to tax you on $0, 40% times zero, which is zero. All right. So what that does, you pay zero taxes. Whereas before, 40% of 100 is $40,000 in taxes. So you would save $40,000 and be able to, you could take that $40,000, go buy 2 more turnkeys, right? Or you could take, half a dozen vacations, all right? And really nice ones at that. That is the beauty of the tax advantages with real estate. So when you do this, if you get a $40,000 raise, essentially, there's no way you could do that in your W-2, right? That's not just a 40% raise. What is that? That's like a 60% or 66% raise. Because really, you're only taking home $60,000 on a $100,000 salary when you're paying 40% of it away, $60,000. So if you get $40,000 on top of that, it's a 66% raise. There's no way you would be able to do that with a W-2. But with real estate, you can. And that's why a lot of the wealthy use real estate as a tax hedge. And to be clear, the IRS knows what they're doing. The federal government, they know that they're giving these advantages. They're doing it on purpose. They know that they are not built to be able to rebuild the infrastructure of America. They need individuals to be self-motivated to do it themselves. And so they've got to give them incentives because people respond to incentives. And so that's why they give these incentives. They say, hey, we'll give you some tax advantages if you do this on top of the cash flow that you make. All right. And So this is the exact number that they're incentivizing you with. $40,000 saving on taxes. Perfect. All right. This is the exact way that Matt did that. So I told that story about Matt Rogers, saving $55,000 in taxes. He did that all by just doing traditional standard real estate investing. It's not anything rocket science. It's just he's a normal guy, just got a family, just trying to provide for his family. That's how he did it. All right. These tax advantages are remarkable. So that's one tax advantage. I wanted to go over my top three. I have a dozen favorites, but my top three favorite tax advantages. The first one is the tax-free cash flow. I absolutely love that. Every dollar that you get in cash flow is tax-free when you do it the right way. The second is called a 1031 exchange. 1031 exchange is a way to defer tax liability on a property that you sold. So let's say you bought a property at $100,000 and now it's worth 400 because you held on to it for 15, 20 years, right? Typically, if you're selling an investment property, you're going to be taxed on the gains. So that would be $300,000. So 40% of $300,000, that's a lot of money. All right. So you don't want to pay that if you don't have to. What you can do is utilize what's called a 1031 exchange, which allows you to take that money and not pay taxes right now, as long as you put into a similar type of investment. So a 1031 exchange on real estate would mean you need to put that money back into a real estate property, right? A rental property. So if you took the sale of the proceeds from that sale and you bought other real estate property, then you don't have to pay taxes on the gain yet. You can defer it indefinitely. Now there are rules around this. You have to use a qualified intermediary. You've got to use a very specific process. And if you get even one little thing wrong, then you end up paying taxes on all of it. But I've done a 1031 exchange. It's very simple. You just have to take the right steps in the right order. When you do this, you have a certain window of time where you can use that money to buy another house. The rules are, as of today, you have 90 days to identify a new property to buy with that money and 180 days to close on that property. So you can't just cash it out and spend all that money and say, well, I'm going to do a 1031 exchange and it'll be 5 years down the road. You have a very specific time frame, and there it is unflinching. So you can't go can't go 181 days. Then you're paying taxes on everything. That's the 1031 exchange. The final one of my favorite is a cash out refi. Now, cash out refinance, what this is when you refinance your loan on a property, most of the time it's a rate and term refinance, meaning you're just taking the amount that's left on the note and refinancing it over a longer period of time, maybe at a better rate, so it decreases your price. But you're really just changing the interest rate and the term. So that's why I call it a rate and term refinance. If you have equity in your property, you can actually pull money out of the property. And so let's say that you've got that same example, a $400,000 property with $100,000 left on it. You can do a cash out refinance and you can refinance up to 80% debt on that property. So 80% would be $320,000, right? But 100 of it's already spoken for because there's already $100,000 of debt on it, which means 320 minus 100 is $220,000. They will give you a check for $220,000 at closing. Right now, that's accessing that money, and now you're on a long-term note again. Right, so your principal's probably going to go up, or your monthly payment's probably going to go up because your principal went up. The beauty of this, though, is when you get a check, when you get cut that check, it's technically a loan because your mortgage rate's 5% or whatever they're giving you. It's a loan, and a loan is not a taxable type of income. All right, so it's tax-free. That is not a taxable event. A cash out refinance is not a taxable event. So if you go and you end up cash out refinancing a property, you got $200,000, $220,000 to do whatever you want with it. So in my second aha moment, my 15-year plan, at the end of that 15 years, I could either just leave it and cash flow and I lose a little bit of the tax advantages, or I do a cash out refinance and I take a $300,000 paycheck every single year. And at the time, I thought, golly, $300,000, how could I possibly even spend that much in 1 year, right? $300,000 paycheck every single year, tax-free, the cash out refinance. So those are my top three tax benefits. Now, again, I'm not a CPA or a tax professional, so go consult with your CPA because this is just for educational purposes. Okay, so we went through cash flow, we went through appreciation, debt pay down, and tax advantages. For the 5 ways that real estate transforms your wealth. These are the things that the wealthy know that other people just don't. There are unwritten rules. Sometimes there are even written rules. Just people just don't know them. The fifth one is leverage. Now, when I first bought my house, I mentioned buying that first house. I didn't think I'd be able to. I mean, we don't come from money. I didn't have much money growing up, and neither did my wife. But at the time, I worked really hard. I was a good little boy, like I mentioned. I was making good money, but I didn't have $250,000. That is for sure. I didn't have even 20% of that. That was $50,000. That was crazy. That was almost as much as I was making yearly at that point. So what I ended up doing was putting 3.5% down. And so instead of my down payment being $50,000 on a $250,000 house, it was $87.50. All right, something like $9,000, and that was much more doable for me. It ended up leaving me with a few $1,000s just in case something went wrong. But the lender financed the other 97% of it, 96.5% of it. Right? This is leverage. I use other people's money to buy something that I otherwise would never have been able to buy. I would have had to save up in perpetuity, and it would have continued to get more and more expensive, and I wouldn't have been able to buy it at any point. That's leverage. Leverage is using debt or borrowed capital to undertake an investment purchase, not just real estate. You can do this on other asset classes, but the leverage opportunities on real estate are unique among asset classes. There are a few different functions of leverage that the wealthy use, three in particular. One is that leverage pays for the property. It allows you to buy a property that you just couldn't have bought otherwise. There's no way you would have been able to buy it. You don't have to fund the entire purchase. You can use other people's money to buy the property. For every $1 that you put into the property, you get 4 in value. All right. So you can putting 20% down, you get to buy a whole $100,000 property. There are countries out there that don't allow this. They don't do 30-year mortgages. They don't allow leverage. I was talking to a business owner in Bali recently who said he really wanted to get into the United States real estate market because Bali doesn't allow them to leverage. They have to buy in cash. They don't have a 30-year mortgage or fixed rate mortgage for them to be able to use to buy property. So this is really, really remarkable. Now, not only do you get $1, you put $1 in, you get $4 out, but you can't really leverage on other asset classes the way that you can with real estate. Stocks, you can't really leverage. There's technically a mechanism for it, but the problem with that is when you leverage using stocks, if the value of the stock goes below where you bought it, you have to then pay premiums every month in order to cover your losses. And so if it goes down, you've got to come out of pocket. Whereas real estate's not the case. So if you bought at the top of the market and the next 2 or 3 years your home price dipped $5,000, you don't have to pay premiums on that. Then in 10 years, when it's doubled in value, because you were able to hold it over time, you're fine. You didn't have to sell it because you had to pay premiums. You can't do that with the stock market. If you put $100,000 into a stock, you get $100 worth of stock. You don't get $400 or $500 worth of stock. And most people just can't do this. They can't. They can't find leverage on a stock or other type of or bonds or something like that. You just won't be able to do it sustainably and with any amount of risk protection. So that leverage is absolutely unbelievably valuable for real estate. So one of the reasons it's unbelievable is if you bought $100,000 property and it appreciates say 10%. What return on investment is that? Return on investment is the way that we evaluate. Unlike asset classes, we can compare investing in real estate or the stock market to buying Beanie Babies or baseball cards because we can look at the ROI, right? So when you buy a $100,000 property and it appreciates 10%, you end up making 10% on that property. But let's say instead, if you had $100,000 and you were asking, well, should I put this into one property or multiple? Just buy one $100,000 property in cash? Or should I buy multiple properties? Well, you can actually if you end up buying multiple properties, you'll get a better ROI, which I'll talk about here in just a second. But if you think just about, a 10% appreciation on 20% down, you made $10,000 on that $100,000 property. So $10,000 is your return, 10 grand divided by 20, you made 50% return on that property, right? $10,000 on a $20,000 investment, that's crazy. And home prices appreciating 10% in 1 year right now is not out of the question. I think that's very reasonable. In 2 years, definitely very reasonable. And that's a 50% return. You won't be able to, it just helps your money go further. You won't be able to get a better deal. 50% return, you can't get that in the stock market. You can't get that in another asset class. So it allows you to stretch your money further. So that's the first part, is it pays for the property. The second is that leverage allows you a better ROI. So not only can you make 50% on just a turnkey property, but if you were to take the question that I posited just a moment ago, and you said, I got $100,000, I'll hear this question often. If I have $100,000, should I buy one property in cash and just not have a mortgage? There's some psychological safety to that. And maybe you cash flow a few $100 a month, but you don't have a mortgage payment. So your total cash flow is, let's call it $800 a month on a $100,000 property. Instead of doing that, if you put 20% down on 5 properties, you would actually make more cash flow and more money overall because of your tax advantages. So think of it this way. Instead of taking $100,000 and putting it over on one side, on the other side, you put $100,000 into 5 properties, 20% down. Right now, if you did this on a $100,000 property, instead of cash flowing about $800 a month on the one property where you bought it outright, that would be $800 a month on a $100,000 investment. That's about a 10% return, right? Over 12 months, a cash on cash return, 9.6% cash on cash return. If you did that with 5 properties and you paid $100,000 for each, but would use 20% down, you would make about, instead of $800 a month on that door, you would make about $300 a door per month. So instead of $800 a month in cash flow on that one door, you would have $300 a month times 5. That's $1,500 a month. So you almost double your cash flow profile by using leverage. And on top of that, when things appreciate, if they appreciate 10%, instead of just appreciating $10,000 and you make $10,000, now it appreciates $10,000 a door. So you make $50,000. Right? Now imagine not just having 5 doors, but having 15, 20, 40, 100 doors. As appreciation continues to grow, the leverage that you use will not only pay for the property, but it'll get you a much better ROI. So instead of a 9.6% cash on cash return, if you did it with 5 doors, you can get an 18% cash on cash return. And you end up with more tax advantages because the money's tax free. Because you have, while it's still, if it's owned outright, you still have the operational costs and the depreciation, but you don't have the debt service cost because you don't have interest on the property. All right. So it's less tax advantageous to do it to buy a property outright than it is to buy a property, 5 properties, 20% down. All right. So that's the second component, is it gets you a better ROI. So it pays for the property, gets you a better ROI, and then it also pays you. So after you own the property, let's say for 5 or 10 years, and it appreciates, you can access that money. You can't access it like it's just a checking account. But how we talked about home prices doubling every 10 years or so, you can actually access that money without selling. And this goes back to one of my favorite tax strategies, which is the cash out refinance. So when you do a cash out refinance, let's say you bought a $200,000 property and now 10 years later it's worth 400, right? You now owe probably about $120,000 on that note. So you owe 120 and it's worth 400. The bank will give you a loan for 320, right? Because it'll go up to 80% LTV. So you've got $200,000 that you can walk away with in your pocket. And that's not a taxable event. That's the equivalent of a $330,000 taxable amount. So you get $200,000 in your pocket, and it's not income considering according to the IRS. It's debt. It's a loan. So it's not a taxable event. And so when I think about my second aha moment, you've got, if I'm paying off a property every 15 years or one every 15 years, and then at 15 years every single year, I could just take out a cash out refi, and cash out $200,000 every single year, $300,000 every single year, which is crazy. What allows you, it keeps more money in your pocket, right? We talk about Kiyosaki saying it's not how much money you make, it's how much money you keep. And this is that component, is it allows you to keep more money in your pocket so that it can work harder for you. You can go buy a boat or a fancy car. You can go reinvest that into other properties, right? That would get you 10 properties easy. All right. But that's the power of leverage, is pays for the property, get you a better return, and then it also pays you. All right. So that's the fifth component. So we went through all 5 components, right? We went through cash flow, appreciation, debt pay down, tax savings, leverage. But I want to talk, why does this matter? Like, why is it important to you? And the wealthy know this stuff, so you've got to learn it if you want to be wealthy. You have to understand what the wealthy know in order to be able to do anything about it. But we talked about return on investment, and it's how we value any investment mechanism, any investment asset. It allows us to compare unlike things. So, we think about a savings account. You make 0.25% in your Wells Fargo account, your Bank of America account. Maybe you got a high yield savings account that makes you 4%, or a mutual fund at 7%, maybe an index fund at 8 to 10%. It allows us to compare those things so that we can say, well, if I'm going to take a little bit more risk, then I want the commensurate reward. The reason why a savings account is so dirt low on your return is because it's so safe, right? And then you've got a little bit more risk with a high yield savings account, and maybe a little more risk with mutual fund or index fund, right? But with that increase in risk, you get a better return. The reason why this is so important is when we look at our ROI, the wealthy love this. If we look at our ROI completely put together, it's a completely different story. It's a completely different story because let's say we've got a $100,000 property and we put 20% down. We put 20% down on that deal. That's going to be the investment on the bottom for each of it. But our return profile, unlike a stock where the return is just the growth in the stock, if we put $100 into stock and it grows to 110, we made 10%, right? We made $10. That's a portfolio gain return, right? Or a capital gain return. That's only one piece. For real estate, there's 4 pieces. You've got the cash flow, because you're making money every single month. You got appreciation. You have the debt pay down because someone's paying down your debt, and you have the tax savings. So we need to add up those return profiles across the board. And what the return actually is remarkable. It's absolutely bonkers. So let's say you got a $20,000 property or a $20,000 down payment on a $100,000 property. $300 a month, $3,600 a year, 3,600 over 20 is 18%. And then let's say it just appreciates $5,000. Be really 5%. That's $5,000. Very conservative. $5,000 over 20 is 25%. Your debt pay down. I ran this through the amortization calculator. It's going to be $1,100. Tax savings $1,600. Your debt pay down return is going to be 6%. Your tax savings and the tax savings. This isn't how much less you're going to be taxed on. This is actually the cash in your pocket on this one property. So if you add all of those up, you're seeing that your total ROI is 57% on one property in the first year. That's the average return for me on turnkey properties, just things I put 20% down on. That's not even a super efficient way to invest. It's just if you got cash, you can just go buy them. All right. So 57%, I challenge you to find any investment mechanism that will allow you to do that. That's crazy. Those returns, that's not even a creative way to buy real estate, and it gets you 57% return. That dwarfs other investment returns. This is why it's the secret of the wealthy. This is why they use it the way that they do. These 5 things are the reason why Andrew Carnegie, one of the wealthiest people in the history of the world, Andrew Carnegie said this. He said 90% of millionaires become so through owning real estate. And this next sentence is absolutely ridiculous. More money has been made in real estate than in all industrial investments combined. More money has been made in real estate than all other industrial investments combined. The wise young man or wage earner of today invests his money in real estate. So if we're talking about what the wealthy know, Andrew Carnegie is the king of the wealthy. And what he has said is more money has been made in real estate than in all industrial investments combined. And that those that are wise invest their money in real estate. The wealthy know these things while other people just don't. They also know how to use them in the right way. So the first hurdle is figuring out, well, what do the wealthy know and what are the cheat codes? And then second is, what do I do with that? And so next, what we're going to talk about is we're going to be talking about 4 simple ways that the wealthy win with real estate. So today we talked about what they know, right? What the wealthy know. Next, we're going to talk about what they do with that information that's different from everybody else. Because if you do this wrong, these ways that the wealthy win, if you do any of them wrong or you overlook them, they will cause you to fail. You will absolutely fail. And so I want to make sure that not only you know the information, but you know what to do and how to do it. And so what I'm going to do is I'm going to walk you through those things. So get your pencils ready, get them sharpened, because you're going to have some work to do in our next session. All right. We'll see you there.